Okay, so what I've done here is I have kind of a timeline of accounting cycles. Now these cycles can be months, they can be years, they can be quarters, but they always have some sort of periodicity to them. Now the way that it starts is you start with the financial statements from the previous month, and I'm going to just say month as instead of period, but it can be year. And then you open the accounts onto your T accounts to begin the process of recording things for accounting. You then record the transactions. You close the accounts, which we're going to talk about exactly how that goes about. What are the procedures for closing them? And then you generate financial statements. Then you begin it again. You open the accounts, you record the transaction, you close the accounts, and you generate financial statements. And this continues on every year all the time. And you have then a whole bunch of periodically set financial statements. Now let's look at closing the account. There's actually a procedure associated with this. The first is to draw lines under the account and calculate balances. After that, you go ahead and create an net income account into which you close all the income and expense items. Then you double entry all of the net income values into the retained earnings account. That's the process of closing the accounts. I'm going to go ahead and show you an example associated with this. We have this example, and you have this on PolyLearn, where we have this particular initial balance sheet, and then we have transactions that are occurring. So we're going to go through this process and generate accounts. The first step of it is to open up all of the T accounts with these balances. You might want to stop the video and get a piece of paper out and open up all of these accounts with the correct balances. And that will help you test whether you have kind of the right debits or credits on the T accounts. Okay, so you can see here I have all of the balances set into these accounts, and you can tell you want to make sure that you've entered them in the same order that I have. I mean, on the same side, not the same order, the same side, whether it's debits or credits. That's going to be important that you have that right when you're doing it. So you sold 1,000 items for $1 each. So you're going to kind of record that as sales of these products. Going to put $1,000 in sales. And then it says it's half on cash and half on credit. So what that means is you're going to take $500 and put it into the cash value because we collected actual cash for that. Next, we're going to put the $500 into accounts receivable because that was sold on credit. Now we want to look at the cost of these items. The cost of the items were 20 cents each, and they were 1,000 of them. So that's going to be $200. We're going to assume these values came out of these items came out of inventory. We didn't buy them in the period. We actually had them in inventory. So we're going to create an account called Cost of Goods Sold, COGS. And in this, we're going to put a credit entry because it's a decrease in equity of $200. And that $200 is 20 cents times 1,000. For the other side of this account, we're going to take these $200 or these 1,000 items at 20 cents each out of inventory. So we're going to go ahead and put a credit entry in inventory that matches that debit entry in cost of goods sold. Now the next thing, the next transaction that is occurring is we went ahead and bought 800 units of, again, 800 units, and they were 25 cents each. They're not 20 cents each, they actually went up in price. So that $200 we're going to say we've added to inventory. Now it says that we bought that on account. So we didn't pay cash for it. We didn't pay for it yet. We got an accounts payable with our vendor. So that means we generally increase the accounts payable by $200. The next one is we're going to pay our employees $200. So you can see I decreased cash by $200, and now I'm going to create another account called salaries, and I'm going to have a debit entry in that for $200. The next one is that we paid utilities of $50. So again, we're going to create another T account that's called utilities, and we're going to put a debit entry of $50 in there and then a credit entry to cash to show that we've decreased the cash account by $50. After that, we go ahead. The next one is receive payments from customer for previous sales of $150. This means that our people who owed us money paid us back $150 in cash and $150 in accounts receivable. We got a no long-term loan of $500. Now, obviously, this goes into long-term debt. We're going to go ahead and say that we have a higher long-term debt of $500. And when we get a debt, that actually has the effect of putting cash in our checking account of $500. The next thing is we're actually going to make a payment on the loan. And the interesting thing about this payment is all loan payments are made up, most all loan payments are made up of principal and interest. The principal is the amount that you decrease the amount you owe by, and the interest is kind of like rent on your money. So when we're considering this $100 loan payment, half of it is interest and half of it is principal, but all of it comes out of cash. So we put it as a credit in cash. For the debit sides, we're going to include a $50 decrease in principal on the long-term debt, and then an interest expense that's $50. You might just want to remember this is how you record these values. It's not something you might be able to figure out, but it is how it's done. So the next thing is that we booked $100 of depreciation. Depreciation is the recognition that your assets are wearing out. It's like an expense. You're using up your assets. So we want to include it in our expenses as $100 as a debit entry. The other place that occurs is in accumulated depreciation. We want to accumulate that depreciation, mean that we want to recognize our assets are wearing out, and that offsets the value of the fixed assets. So we're going to go ahead and put $100 in accumulated depreciation. It's a little bit hard to see that, but that's where that value is. The next is we're going to pay $100 on short-term debt. That is a cash payment of $100 that ends up decreasing our short-term debt by also $100. Now we're assuming that this is all principal, meaning that there's not going to be any interest expense associated with it. It's all just principal. So the payment comes out of cash and then we decrease the balance on the short-term debt. And the last thing we're going to recognize is that we paid $200 on accounts payable. Wait a second. So we're going to pay $200 on accounts payable. That means we took some of our cash and we paid back the people we owed money to. So $200 credit in cash and a $200 debit in accounts payable. Now that finishes up all our transactions. So in the closing of the accounts, the next thing you do is you actually draw lines underneath each of these accounts, and then you calculate balances. Now I would encourage you to stop the video and do your own balance calculation on these things. So right here, what I have is I have all the balances. You might want to make sure that the values are the same and on the same side. The next thing we might want to do is to consider whether all the debits and credits equal each other. So I'm going to write down all the debits and all the credits, add them up, and make sure they match each other. Again, you might want to stop the video and do this yourself. So I see that my total debits and total credits are $64,500, which makes me very happy that I have done this correctly. The next step now in closing the accounts is to create another T account under equity that's called net income. And what we'll go ahead and do with that account is we're going to go ahead and close out all the expense and income accounts into this account, and then close that into retained earnings. So I'm going to double entry account all of the values. First, the sales numbers goes as a debit and then a credit into net income. After that, I'm going to do cost of goods sold the same way, 200 and 200, followed by salaries of 200 and 200, utilities of 50 and 50, interest of 50 and 50, depreciation of, whoops, I put it in the wrong place, depreciation of 100 and 100. Now I'm going to go ahead and calculate the income here. And in this case, the income is $400. And then that income then I'm going to close out once more and put it into retained earnings. And after that, then I have only accounts that appear on the balance sheet showing up with balances in it. All the other accounts, the net income, depreciation, interest, utilities, salaries, cost of goods and sold, and sales, those all have zero balances. All of these have zero balances in them, and they actually can be discarded now because we don't really need them, although they do record something about how we got to that. Now what we're going to do is just take all of these accounts and create it into both a balance sheet and an income statement. Okay, so here's the balance sheet that I created with the balances from those T accounts after we recorded all the transactions. And you can see that the assets is equal to total liabilities plus equities, and all of those values are the balances. On the short-term debt, there's a zero balance. And usually when there's a zero balance in an account, you don't list it on the balance sheet, but I went ahead and put it in there today because I wanted to show you that we were including all the balances. The next report you might create is an income statement. Now remember, it's for the month. So what I've done here is I've summarized all those T accounts under income and expenses, and I put them in there and I totaled up all the expenses and then indicated the net income. Now it seems like a pretty simple thing to do. It's not very sophisticated taking the income statement off of the T accounts, but it is necessary to do that to make it this kind of statement in this format. So I hope now that we've gone through a whole accounting cycle from opening the balances, recording the transactions, closing the balances, and then creating the financial statements.